Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is July 3rd, 2024, and today we're going to talk about how to buy growth stocks in an economy that isn't growing. We're seeing multiple signs, despite the fact that we hit a new record high in the S&P 500 and the NASDAQ as we're pushing up to these new record highs today. We are seeing multiple signs that the economy is slowing. We're seeing multiple signs of that dreaded beast, the uncertainty of stagflation. And as we're watching this, we're pushing to these highs, we're seeing signs of this ahead of non-farm payroll on Friday. But that's why we're here. That's what we're looking at, and why we're here is because we are doing this at a time that we are seeing the shifts and the changes. And I do want to remind everyone that we are doing a live event coming up in September, and I think this is going to be a great time to be doing this and preparing for the stagflation. I'm going to talk today about specific stocks that you can be buying ahead of stagflation or as that stagflation emerges, but we're going to be doing similar things as we do this at our conference. Go to TheoTRADE.com/24 and you'll be able to register for all these events. All these events that we're doing and the class we're doing are all new content and adaptive to the current time frame. So the trading topics this year are going to be new. They're going to be time specific. They're going to tie directly into what is happening in this economy. Now, Friday, again, we're going to be dealing with non-farm payroll, showing that that slowdown is still there, but there's opportunities in this market. Go to the website, go down to the bottom, click on buy your tickets, and then book your room. Book your room as soon as you can after you buy your tickets, and join us there. I'll be talking about some interesting ways to approach the market in the breakout type of move after a squeeze, and a lot of other new topics that I've never covered before, and including the idea that we're talking about today, and that is when the S&P is rising and we're rising on a slower process while we're seeing economic data slow. We're seeing growth slow in GDP. We're seeing non-farm payroll slow and getting lower and lower. We need about 250,000 jobs just to be outside of the margin of error to have a positive jobs data. And we're expecting closer to 175 to 180. And so we are expecting to see continued slowdown in the market. The S&P 500 reaching record highs. So this is being driven off of inflation, and inflation is driving higher and higher, not just in the US, but in the world. I brought this up in our live room today that gold is up against every major currency today, pushing up to these near-term highs. And the Fed yesterday was talking repeatedly about the fact that they are trying to get control of inflation still, that they've had a lot of progress but haven't got it taken care of yet. And so as gold is rising, the dollar is losing, we are seeing inflation. But yet we look at copper, it's not pushing to new highs. We look at the growth data, we look at non-farm payroll, we look at wages, and the growth is not there. And so stagflation is a potential concern. So to discuss this, what I'm going to do is I'm going to go through a stock that is a substitute for gold. If inflation is going to remain high and gold is going to continue to climb, we want to substitute for gold or just trade directly into gold. We're going to talk about a constant, we're going to talk about a utility, and we're going to talk about a substitute. So to start out with, if we're looking for gold, let's take a look at Barrick Gold. Barrick Gold Corporation. If gold is still climbing and we're seeing companies that benefit from rising gold prices, and the simple ticker to remember, type in gold. So as gold is Barrick Gold Corporation, we've had a sizable breakout today. We have higher lows, and it looks to me like we're going to go back and at least retest the highs near 1855 high resistance area. Maybe not the 19, but 1850, 1855. If we're looking for $1.20 in this, it's about an 8% move higher in gold, the ticker symbol gold, and looking for it to push up to these levels. The nice thing is Barrick Gold also provides a dividend at about 2.3%, and I think that's a good setup right through there. Good substitute for gold. If you want something that is constant, you'll know that Costco is one of my favorites. Costco is holding up near its highs, and as we're holding up near that high, we're looking for this to break out, push up, and continue this trend higher. Now their dividend is next to nothing, so it's really a directional play, and knowing and seeing that Costco has been able to gain almost 60% this year. If we can continue this, or if this is a bull flag and this is a breakout today, where we had a gap down, close higher, and push through that high right through here. Then Costco looks like it has upside potential, not just back up to 870, but the trajectory could take us up to 920, 930, 940, and I'm looking at a 10% move higher in Costco. Being near the high, and if you look at the Costco's option statistics, the volatility is relatively low. This would be either buy the stock or buy a long call, or buy a long call in later months and sell calls against it to lower your cost. This is a pretty good opportunity to be long the stock or long options because the cost is relatively low. And if inflation is high and costs are high, we have a tendency to still spend money on the things that we need day to day. Costco will benefit from that, but also so will utilities. Nextera gave me an interesting bounce off of a gap down, close up, and then we gapped up, closed up. Here, creating higher lows. I think Nextera is poised to go back up and test 80, call it the close price here of 80.02, but $80. That means from the current price of $71.80 to $80, we're looking for about an 11-12% move higher. The nice thing about Nextera, it also pays a 2.87% yield if we're buying this and just holding it for a while, and potentially gaining a 12% move higher. The options are near the 50% implied volatility, which means we could structure this multiple ways. If we're looking at a month's worth of time decay or a month's worth of premium on a short put, if you sold the at the money, we're currently at 71.82, at the money put for a month, you would get 3% for 1 month for being willing to buy Nextera. And that's at 72. So if it drifts a little bit higher and gets out of the money, then you're not going to get the stock. But if you do, you're going to get about 3.1%. And again, they pay a 2.87% dividend. So I'm on the edge whether I'd want to sell a put to get into this and collect 3% for the month, knowing that I expect it to go 12%. It probably won't happen in 1 month to go 12%. So if I can get assigned and get my 3% while I'm waiting, that is kind of attractive to me. But if you just want to buy the stock is 71.81, and you can sell calls out of the money up there at a higher level. Say sell the call out for the 34, collect $1 there, and you're going to get about 1.5% reduction of cost on Nextera while still benefiting from the dividend. So now, having talked about Barrick Gold as a substitute for gold, Costco as a constant that we still buy from Costco in all economies, talking about Nextera as what we do as safety play in utilities, as a defense stock, and something we will still continue to spend money on our electric utilities. The last one's the substitute. And the substitute would be something like, instead of buying your clothes at the stores, you're going to buy them at the outlets, something like TJX Companies. This is your TJ Maxx, your discount stores. And as we're looking at TJX, you can see that we're holding near these highs and held that consistently. From this last year, we've already seen that it's gained about 20%, but this higher high, higher low, higher high, higher low, this acceleration up here, to me, is a confirmation that we're seeing a flight to safety, or better yet, we're substituting our purchases as consumers. We are not buying from the retail generally, we're buying from discount retailers. And we're looking for that safety or the lower cost. We are trying to substitute out our high cost for our low cost and pushing this stock even higher. And that's going to be seen all over the world. They have in the US, Canada, and international, they have the Marmax, the Home Goods, like I said, the TJ Maxx outlet stores, the retail discount outlet stores, plus their e-commerce space. So what is the options? What does this look like as far as the setup? If we look at the option pricing and we look at the value, despite the fact that we are near the highs, the current implied volatility is 66%. 66%. That is a very high premium to pay for a stock that's at its 52-week high. That means that there's some uncertainty there. There's some premium to be collected. And if we're going to collect premium and think it's going to go higher, I want to look at this as a short put or a short put vertical. And the short put, we're almost dead center between 110 and 111, so I could go either one. But even if we did the in the money at 111, they're only going to pay me 1.8%. So even though that 66% seems relatively high, for a month, it is only 1.8%. I like to see that about 2.5%, 3% or higher is really where I love to sell puts. But at this point, we're not getting paid that premium. And that would have me looking for something more like the short put vertical. So if we're at a support level or resistance level, or even this consolidation that we just saw in the chart, I would look to sell a delta 42 or lower. In this case, it is 42. Sell the 110 and buy the 109. And at this point, I get 33-cent credit. This is the standard 33-cent credit versus 67-cent risk or debit. That gives you a 50% return on risk, where you have to be right about 66% of the time, or not be wrong 34% of the time. So that doesn't look like we have a statistical edge in this, but I think this is a good setup. As long as it doesn't go lower, we are set up to continue to move higher. Now this is just because I'm using 30 days. If I'm going to be a seller, I want to sell likely closer to 21 days and get this higher implied volatility. I just like to look at the 30 days, 1 month, what is its return on a 1 month. So dropping it down to the 26th of July, about 3 weeks out, and looking at the same strikes, same 42 delta, same down here, 110, 109. And look, the same payment for a week less. So I like this one better because I can get the same premium, same payment, same risk, but I only have to deal with it for 3 weeks. And so the time decay is going to be faster on a short put vertical for July 26th. Everything else is the same. Delta, probabilities, premium, credit, all the same. And I only have to do 23 days instead of 30. So I like this one better, going with that July 26th and setting up that trade. As a bonus stock that will generally do well during uncertainty and stagflation would be healthcare stocks, and specifically Pfizer. Pfizer has been knocked down from its highs. It's gone from 37.80 all the way down to 25. We've seen about a 35% correction. At this moment, we can see that we've bounced off the lows. We've consolidated here in the space between December, January, February, March, all the way over to June and July, and it still appears we're consolidating. So despite the fact that it's drifting lower today, this is an area that I would start looking to set up a trade, and preferably a trade that collects premium even if it does nothing, because it looks like it might do nothing. I like to do this when I have current implied volatility over 45 as a percentile, not percentage, but percentile, and look to sell those puts or those put verticals down here at the bottom. There's not a lot of volatility in the market, and so finding the volatility in these is, I think, an opportunity. The current IV percentile, 54%. So it's higher than my 45, it's higher than halfway. And if we look at the month right here and look at the current price of 27.67, we're closest to 28. So the at the money short put will pay us somewhere between 113 and 119, which is 4% for a month. 4%. That would be annualized. If you calculate this out, this is over 50% annualized if we just sold short puts at the money and had it not assigned. Even if we get assigned, it's saying I'm willing to buy it at 28. I'm getting a payment of about 115. We'll go halfway in between. And so my break even on this, even if I do get assigned, is 26.85. Looking at the chart, am I okay with that? Yes, because that is below the next support level. And so you can let the knife stop falling. You can let it drift back down here to 27 and maybe do the same thing at 27 and get 4%. But I actually like the short put setup on Pfizer as a substitute, or better said, a stock that would work in stagflation, and collecting 4.3% for 1 month of being willing to buy it. And if we do get assigned, great. We now own it at 28, but our real break even, our real cost basis is 26.85. That is below the support level. And so we'd have to sell off, break through support, and have plenty of time to make our decision to get out of that trade or sell calls against it to reduce our cost further. This is a strong basing pattern. I see a test of the lows and now a higher low setup. And we don't need it to go up. We're just going to look to collect that 4%. And by the way, Pfizer pays a 6% annualized dividend. So not only can we get 4% to buy into it, even if we do get assigned, we will now collect a 6% dividend on a stock that is deeply discounted on this chart. All of that to set up opportunities that we see shifts going on in the economy. So to repeat, what did we look at? We looked at inflation pressures. We saw gold, and we looked at GOLD, Barrett Gold, as a substitute for gold. We looked at a constant with Costco. Costco is a constant and has a tendency to maintain its growth and its patterns for long periods of time. We talked about a substitute stock with TJ Maxx, and looked at that from the perspective of its discounted price. We talked about a utility, Nextera, that we have it. Nextera and utilities generally do well during slow economies. And then we talked obviously about Pfizer as a bonus stock to look at in conjunction with all of these moves. And one last reminder again, don't forget, join us in September in Scottsdale. We will be doing lots of new content, lots of big picture views. I'll be talking about some long-term and some short-term and content that I've never shared before, as well as new systems. And there's going to be a lot of that. Lots of time-specific trading topics that we're all working on to make this one of the best events, if not the best event of all time that we've done so far. So join us in September. Go to TheoTRADE.com/24. Otherwise, I will see you next week. Have a very happy 4th of July.